Right now, today there's a window open that has only appeared twice in the last 100 years. The people who stepped through it both times became generationally wealthy. The people who hesitated, watched from the outside. This video is about that window. And more importantly, how long it stays open. Hit subscribe if you want to keep running the real math on moments like this. There is a pattern in history that nobody teaches you in school. Not in economics class. Not in business school. Certainly not on the news. It is the pattern of the window. The brief, brutal, quiet period where wealth transfers at a scale that does not happen in ordinary markets. And the terrifying thing about it is this. It never looks like an opportunity when it opens. It looks like chaos. It looks like fear. It looks, to most people, like exactly the wrong time to move. Let me show you what I mean. 3 moments. 3 groups of people. 3 very different outcomes. The first group bought equities between 2001 and 2003. The day crash had just wiped out trillions in market value. CNBC was running segments on financial ruin. The people who stepped in anyway, the ones who bought broad index funds or specific beaten-down technology companies, didn't look smart. They looked reckless. Their neighbors thought they were losing their minds. Some of them doubted themselves every single week. But the S&P 500 returned to full value by 2007, and the stocks they picked, specifically, some of them returned 10, 15, 20 times that initial investment within a decade. The second group bought real estate in 2009. The housing market had collapsed. Entire neighborhoods were underwater. Banks weren't lending. The news was wall-to-wall, devastation, foreclosures, unemployment, the word depression being used on television for the first time in generations. The people who bought in that window, who had any access to capital and used it on residential property, didn't feel clever at the time. They felt scared. Some of them bought their first property for less than the cost of a decent used car. By 2019, those same properties had doubled, tripled, sometimes quadrupled in value. The third group, you already know. Early Bitcoin. Early positioning in digital assets before institutional money entered the space. These aren't just internet legends. These are documented, verifiable outcomes from people who are not geniuses. They are regular people who saw something structural and acted before the crowd validated it. Here is the pattern hiding inside all 3 of these moments. Are you seeing it? They all looked crazy at the moment of action. Every single one of them. The dot-com buyers looked reckless. The 2009 real estate buyers looked delusional. The early crypto holders looked like they were gambling their savings. The crowd was not wrong to be skeptical. The crowd's skepticism was rational, given what they could see at the time. But the people who acted, they weren't seeing the same thing as the crowd. They were seeing one layer deeper. They were seeing structure where everyone else saw noise. What they saw that everyone else refused to see. That's exactly what I'm going to show you today. Stay until the end. The closing window signals I reveal at the 2-hour mark are the most important part of this entire video. I need you there. Write that down. Set a reminder, because what comes at the end is not a CTA. It's the specific, measurable signal set that tells you with real data, not opinion, when this window starts shutting. And once it starts shutting, it moves fast now. The reveal. What is the actual opportunity? I am going to name it clearly, because vague financial content is how people lose money. Vague content keeps you consuming without acting, and I am not in the business of keeping you watching. I'm in the business of getting you moving. The opportunity is this. We are currently sitting inside a structural repricing event in a specific class of income-producing assets, assets that generate cash flow, that have historically tracked inflation, that are currently being treated by the broader market as if interest rate conditions from 2 years ago still apply. They don't. And the gap between how these assets are priced right now and how they will be priced 18 to 36 months from now is if the historical pattern holds the largest single-cycle repricing opportunity most people alive today will ever see. I'm talking specifically about a category of assets that straddles public and private markets, real estate investment trusts, dividend growth equities, and select income infrastructure, all of which got absolutely destroyed during the rate hike cycle between 2022 and 2024, and all of which are sitting right now at valuations that the historical data says they should not be sitting at, given where we are in the rate cycle. This is not a guess. This is not optimism. This is pattern recognition from documented market behavior going back to 1928. Here is the math. Simple, honest, no embellishment. If you had purchased a diversified basket of high-quality dividend REITs at the bottom of the 2009 cycle, specific names, specific sectors, nothing exotic, and held for 10 years with dividends, your total return would have been between 280 and 340%. A $10,000 position in 2009 would have become between $38,000 and $44,000 by 2019. Not in a hedge fund. Not with leverage. Not with any particular genius. Just with the act of seeing the structural moment and stepping through the window. We are sitting in a comparable structural moment right now. The rate cycle that destroyed these asset prices is definitively shifting. Capital is beginning to flow back, but most retail investors are still operating on 2022 assumptions, still afraid of what already happened, still not seeing what is actually developing. A $10,000 position entered at this stage in the right vehicles, with the right reinvestment discipline carries a reasonable, historically backed case for becoming $30,000 to $50,000 over a 10-year hold. I'm not promising that. Nobody can promise that. What I'm telling you is what the comparable historical cycle produced. And I'm telling you that structural conditions that generated those returns are present again, right now, in measurable form. I know what some of you are thinking. You're thinking this sounds like every other YouTube financial video that promised you something and delivered noise. You're thinking this has the same energy as the guy who told you to buy a specific cryptocurrency in 2021. You're thinking, I've been here before, and I got burned. That skepticism is not a flaw. That skepticism is a financial survival mechanism, and I want to honor it. And I'll talk you out of it. Because healthy skepticism is exactly what separates people who build real wealth from people who chase trends and lose money at the top of every cycle. But here's the thing about skepticism that nobody talks about. It has a cost, a real, calculable, compounding cost. The most expensive financial decision most people make in their lifetime is not the bad investment they made. It is the good investment they talked themselves out of. Warren Buffett was widely mocked in 1999 for refusing to buy .com stocks. He was called out of touch. Finished. Irrelevant. He was right. And his returns in the decade that followed made his critics look exactly as foolish as they were. Peter Lynch, who ran the Magellan Fund and average returns that make most people's eyes water, documented this in his writing. The average investor in his fund, he said, actually lost money, despite the fund returning over 29% annually for over a decade. How? They bought after it went up. They sold when it went down. Skepticism at the bottom, confidence at the top, exactly backwards. Howard Marks of Oak Tree Capital has spent his entire career writing about this, about how the moments of maximum opportunity are identical, emotionally, to the moments of maximum danger. The market doesn't give you a sign that says this is the safe entry point. It gives you fear, it gives you headlines, and the people who have built the most wealth in history are the people who learn specifically, deliberately, through study, how to read fear differently from actual structural risk. By the end of this video, you won't need to trust me. The data will do the talking. Now, let's go deeper. Because to understand why this specific window exists right now, you need to understand three things that had to align simultaneously and have aligned right now in a way that I can document and you can verify. The first condition is a rate cycle inflection point. Interest rates rose faster between 2022 and 2024 than at almost any other period in modern financial history. The Federal Reserve's benchmark rate went from near zero to over 5% in roughly 2 years. That is not a normal rate cycle. That is an emergency brake applied to a speeding economy. And what happens when you apply an emergency brake to income-producing assets is not subtle. You reprice them hard immediately. Because the discount rate used to value future cash flows rises. The present value of those cash flows collapses. This is not sentiment. This is arithmetic. The income-producing assets. I'm describing REITs, dividend infrastructure, certain classes of preferred securities lost between 30 and 50% of their value between 2022 and 2024. Not because their underlying businesses deteriorated, not because their cash flows dried up, because the math of discounted valuation changed. That's it. And now, the math is changing back. The second condition is the valuation gap. When assets are sold down based on rate mechanics rather than fundamental deterioration, they create what professional investors call a valuation dislocation. The asset is worth more than the market is paying for it, not as an opinion, but as a verifiable function of its cash flows relative to its price. Right now, high-quality REITs are trading at discounts to their net asset value, the actual estimated worth of the physical assets they own that we have not seen since 2009. That is not a coincidence. It is the same mechanical process happening again. The third condition is the lag of retail capital. Professional money, institutional investors, pension funds, sovereign wealth funds does not wait for certainty before moving. It moves on evidence. And the evidence of a rate cycle shift appeared early in 2024. The smart money has been repositioning since then. But retail capital, the money belonging to people like you and me, the people who get their market news 6 to 12 months late through the mainstream financial press, is still sitting on the sidelines, still afraid of 2022, still not seeing that the conditions that created the 2022 drawdown are no longer the conditions we're operating in. 3 specific things had to align for this window to open. Right now, all 3 are aligned, and that brings us to the historical playbook, because this exact pattern, rate-driven asset repricing, followed by mechanical recovery, has a track record. A specific one. The closest historical parallel is not 2009. It is 1994 to 1996. In 1994, the Federal Reserve raised rates aggressively, 7 hikes in 12 months in response to a strong economy showing early inflation signals. Income-producing real estate assets, which had just barely recovered from the savings and loan crisis, got hit again. Valuations on REITs and commercial real estate trusts fell between 20 and 35%. The narrative in the press was brutal. Commercial real estate will not recover for a decade, one prominent analysis concluded. The people who positioned in REIT indices and dividend growth real estate companies in late 1994 and through 1995 watched those positions return between 200 and 280% over the following 8 years, before the DOT mania had fully developed, before the peak 8 years. If they stayed in, the window opened in late 1994. It started closing in 1997, when the broader market began pricing in what the early movers had already captured. By 1999, the easy money in that specific cycle was completely gone. The people who waited for certainty got in at the worst time. The people who acted on evidence on the data that showed a rate cycle inflection and a valuation dislocation got rich. Now here's the piece that makes most people uncomfortable. While you were watching the news, worry about recession risk and sticky inflation, something else was happening. Large institutional investors, pension funds, endowments, and a specific category of family offices that manage generational wealth were quietly, methodically increasing their exposure to exactly the asset classes I'm describing. This is not speculation. It is documented in quarterly 13F filings with the Securities and Exchange Commission. It is visible in REIT sector fund flows data published by the Investment Company Institute. It is measurable in the bid-ask spreads and volume patterns of the specific securities involved. While you are watching the news, worry about X. The wealthy were doing Y. Here's the receipts. Between the first quarter of 2024 and the fourth quarter of 2024. Institutional net inflows into REIT-focused investment vehicles increased by over 60% compared to the same period a year prior. Public pension funds, which are the most conservative, most risk-averse large capital pools in the financial system, increased their real estate allocation targets. That is not aggressive speculation. That is patient, evidence-based repositioning by the most cautious, large investors in the world. The retail investor didn't see this, because this information exists in regulatory filings, not in YouTube thumbnails. It exists in institutional research reports, not in the comment sections of financial forums. The information asymmetry between where institutional money is moving and where the average retail investor thinks it's moving is as wide right now as I have ever seen it. And historically, that gap is the opportunity. Stay with me. I'm going to show you something in the next section that will completely change how you see this. Because now that you understand the structural conditions, now that you understand WHY the window is open, I need to show you exactly how you walk through it. 3 paths. That's what we're going to build together right now. Because this is not a one-size-fits-all situation. Your income level, your existing financial position, your risk tolerance, your time horizon, all of these shape which path makes the most sense for you specifically. And I am going to lay them out with enough specificity that you can actually make a decision, not explore your options. Make a decision. Path A is the aggressive path. This is not reckless. I want to be clear about that. But it is the path with the highest potential reward and the highest potential volatility. This path involves concentrated positioning in the most highest quality individual REITs in the residential and industrial sectors specifically. Companies with strong balance sheets, low debt-to-equity ratios, and dividend coverage ratios above 1.2x, which means their earnings cover their dividends by a meaningful margin even if income temporarily dips. On this path, you're allocating a significant portion of your investable capital, the kind of position where a 30 to 50% gain materially changes your financial picture, and you are accepting the possibility of short-term volatility in exchange for the potential of outsized long-term returns. The timeline for this path to reach the $1 million milestone from a starting position depends heavily on your starting capital, from $50,000 invested. The aggressive path with consistent reinvestment carries a historically comparable case for reaching $1 million over 14 to 18 years. From $100,000 starting capital that compresses to 10 to 13 years. Not guaranteed. Comparable to what this class of asset has produced in analogous historical windows. Path B is the balanced path. This is where I would personally position most people who are new to this specific opportunity but who have some investment experience and a genuine multi-year time horizon. The balanced path involves building a diversified income portfolio, a blend of broad REIT index funds, which spread your exposure across dozens of property types and geographies, combined with 2 to 3 high-quality individual dividend growth names in sectors with strong structural tail. Think data center REITs, industrial logistics REITs, and residential REITs in supply-constrained markets. On this path, you are accepting a somewhat longer runway to the same outcome, but you are dramatically reducing the scenario where a single bad position ruins the trade. The math on the balanced path from a $25,000 starting position, with disciplined monthly additions of $500 and consistent dividend reinvestment over 15 years, produces an outcome in the range of $350,000 to $650,000, based on historical return profiles for this asset class in comparable rate environments, short of $1 million. Yes, but consider where that person started. And consider that most people reading this do not have a $25,000 starting position. They are starting from much less, which is exactly why Path B exists. Path C is the conservative path. And I want to be clear. Conservative does not mean small. It means the vehicle is structured to minimize downside risk while still capturing the structural opportunity on the conservative path. You are building through a combination of broad real estate index funds, specifically vehicles that hold both equity, REITs, and mortgage REITs in a balanced ratio inside tax-advantaged accounts. The conservative path uses time as its primary tool. The starting position is smaller. The additions are automatic and modest. The reinvestment is consistent, and the outcome, over a 20 to 25-year hold in an appropriate tax-advantaged structure, is genuinely life-altering. Not $1 million in 10 years, but $1 million in 20 from a $300 monthly starting contribution. That is not a fantasy. That is the actual math of 8 to 10% annualized returns, which this asset class has historically delivered across multiple long cycles applied to consistent, automated, humble, persistent participation. Now, the biggest question I get, when do I actually start? Let me be direct with you here, because this is where most financial content fails. The biggest mistake in this specific window, the one that has cost people the most money in every comparable historical moment, is not moving too early. It is waiting for a moment of clarity that never comes. The market does not ring a bell when the window opens. It does not send you an email when conditions are optimal. The clarity that most people are waiting for, the feeling of safety, the sense that everyone agrees it's a good time, that clarity arrives approximately 18 months after the optimal entry point, after the early movers have already captured the easy gains, after the valuation gap has already started closing. Dollar cost averaging versus lump sum in this specific environment. The academic literature is clear on this. Lump sum investing outperforms dollar cost averaging in approximately 68% of historical scenarios over a 12-month horizon. But that statistic hides something important. For most regular people, people with real financial anxiety, people who will panic sell if their position goes down 20% right after they entered, the psychological value of dollar cost averaging is worth the slight mathematical cost. Because a strategy you can stick to is worth infinitely more than a strategy you abandoned in the first dip. The best time was 6 months ago. The second best time is before this video ends. Now, how much do you actually put in? This is where most people either overcome it in a state of excitement or undercome it out of a state of fear. Neither of those positions is optimal. The framework that I find most useful, and that has the most support from behavioral finance research, is what I call the asymmetric bet framework. The premise is simple. In a structural opportunity like this one, you do not need to bet everything to win meaningfully. You need to bet the right amount on the right thing. That amount is the portion of your investable capital that, if it went to zero, completely to zero, would not meaningfully change your current lifestyle or your ability to cover your essential obligations. This is not a formula. It is a personal, honest accounting. For some people, that number is $1,000. For others, it is $50,000. The number itself is not the point. The point is identifying it with honesty rather than guessing, and then positioning at or slightly below it so that your decision-making remains rational even when the position moves against you, as it almost certainly will at some point in the short term. You don't need to bet the farm. You need to bet the right amount on the right thing. Now, here is the section where this really accelerates. The 2 to 3 levers that most people skip entirely, and that make an enormous difference in the actual outcome. The first lever is tax positioning. The difference between holding income-producing assets in a standard taxable brokerage account versus holding them in a Roth IRA for a person in their 30s with a 20-year hold can be measured in hundreds of thousands of dollars of tax-free compounded growth. This is not a strategy. It is a REIT. REIT dividends are typically taxed as ordinary income in a taxable account, meaning they could be taxed at your marginal rate, which for many people reading this is 22 to 24%. Inside a Roth IRA, those same dividends grow completely untouched by tax and are withdrawn in retirement without a cent of tax owed. The math on that difference, compounded over 2 decades, is staggering. And most people leave it on the table because they opened the wrong account first. The second lever is consistent, automatic dividend reinvestment. Not sometimes, not when you remember to do it. Every time, automatically, through your brokerages, DRIP, dividend reinvestment plan. The reason this matters is not intuitive until you see it in the math. In the 2009 to 2019 REIT cycle, investors who held with automatic dividend reinvestment outperformed investors who held without reinvestment by an average of 34% over the 10-year period. Not because they added more capital, because each dividend bought fractional shares at whatever price the market offered, including the months when the market was still scared and prices were still suppressed. The reinvestment was buying shares cheaply, automatically, without requiring a decision. That is what compounding actually looks like in practice. Not a graph on a presentation slide, but an automated mechanism that turns income into ownership at every point in the cycle without requiring your courage or your attention. The third lever, and I say this carefully, because this one has destroyed more portfolios than it has built, is the careful, conservative, asset-secured use of leverage. This is not margin debt on a volatile position. This is using the equity in income-producing property, real, tangible, cash-flowing property to finance a second position in a complementary income asset. The mathematical amplification of this, done conservatively with an absolute maximum loan-to-value of 60% and a debt service coverage ratio of at least 1.3x. Compress a 20-year path to wealth into a 12 to 15-year path, then recklessly done with too much leverage, too little cash flow margin, too much reliance on continued asset appreciation. It can erase everything. I am not suggesting you use leverage. I am showing you it exists, how it has been used correctly, and making it your informed decision whether to explore it further with qualified professional guidance. The mistake I cover in Part 5 has cost people more than any market crash. Don't skip it. Stay with me. Now, the part of this video that I think matters most, not the strategy, because strategy without timing is just theory. The clock. 4 signals. Write these down. Signal 1 is the 10-year Treasury yield crossing and holding above the dividend yield of the broad REIT index. When the risk-free rate, the return you can get from a government bond, exceeds what the income-producing assets in this window are paying out, the valuation math that makes the opportunity compelling starts breaking down. We are not there yet, but watch this. Spread carefully. When it narrows below 150 basis points and holds there for more than 2 consecutive months, the window is beginning to close. Signal 2 is institutional inflow saturation. When REIT sector ETF flows, published monthly by the Investment Company Institute, shift from net inflows to net outflows for 2 consecutive quarters, it means the institutional repositioning cycle is complete. The early movers have finished moving. You're watching capital exit, not enter. That is a structural signal that the repricing has largely occurred. Signal 3 is price to FFO, multiple expansion beyond historical norms. FFO funds from operations is the primary valuation metric for REITs. When the median price to FFO multiple across the sector expands above 20x, the valuation gap that created the opportunity is closed. You are now paying full price or above full price for what was once on sale. Historical data from the 1996 and 2030 in recoveries shows that this expansion typically occurs within 80 and 30 months of the rate cycle inflection becoming consensus, meaning the moment the Federal Reserve publicly signals a sustained rate reduction path. We are somewhere inside that window right now. Signal 4 is media sentiment inversion. This one is qualitative but remarkably reliable. When the mainstream financial press begins publishing optimistic features on real estate investment trusts, when REIT investing appears on the covers of mainstream financial publications as a hot opportunity, the retail flood is beginning, and the retail flood, historically, marks the final 12 to 18 months of elevated returns before the window closes for average participants. Historical data from the 1994 to 1997 recovery and the 2009 to 2013 recovery shows the same pattern. Once the retail narrative inverts from fearful to bullish, the window has approximately 12 to 18 months of meaningful return potential remaining, and then it closes. When you see these 4 things together, write them down. The window is closing. Now, the timeline debate? How long does this actually last? The optimistic scenario. The rate environment continues its current trajectory toward normalization over the next 18 to 24 months. The valuation gap on income assets closes methodically as capital flows back in. Investors who positioned in 2024 and 2025 capture the full re-rating cycle and see returns comparable to the 2009 to 2013 period, which, for diversified REIT holdings with reinvested dividends, produced annualized returns in the range of 15 to 22% over 5 years. In the optimistic scenario, the window stays productive through late 2027. The pessimistic scenario, inflation re-accelerates in 2025 or 2026, forcing the Federal Reserve to reverse course and raise rates again. The valuation gap on income assets widens further rather than closing, which means, in the short term, positions entered now go further underwater before they recover. In this scenario, the strategy does not fail, but the timeline extends. The 10-year path becomes a 13 or 14-year path. The investor who cannot psychologically tolerate a further 20 to 30% drawdown on their position and who SELLS converts a temporary unrealized loss into a permanent realized loss. In the pessimistic scenario, discipline and time horizon are the only variables separating the people who come out wealthy from the people who exit at the bottom. My honest assessment, the balance of evidence, the Fed's stated policy trajectory, the current PCE inflation data, the labor market softening signals visible in the monthly jobs reports favors the optimistic timeline, not with certainty, but with the kind of preponderance of evidence that, historically, has been sufficient to justify positioning what closes the window permanently. 2 scenarios. Policymakers saw a sustained return to a high-rate environment driven by structural inflation that the Fed cannot tame with its current toolkit. This is possible, but not the base case given current data or market saturation, the moment when the consensus of retail and institutional capital has fully repriced these assets, eliminating the valuation gap that is the source of the opportunity. This is the more likely closing mechanism. And when it happens, based on every historical parallel I've studied, it happens faster than people expect. This is not a window that stays open and gets less profitable. When it closes hard. Now, here is the part that I think is actually the most valuable section of this entire video. Because the strategy I've just described, if executed with the following 5 mistakes, will cost you money. More money than any market crash. Because market crashes are external. These mistakes are internal. And you can control internal. Mistake 1, over-leveraging early. They pull to go bigger, to use more leverage, to take a larger position than your honest risk assessment supports is strongest at exactly the moment when the conviction is highest, when you've done the research. When the thesis makes sense, when the historical parallels are clear. That is the precise moment that discipline matters most, because leverage amplifies both the gain and the loss. And the positions that use too much leverage get wiped out in the dip that almost always precedes a full recovery. I have watched people enter a trade with perfect timing and perfect thesis, and then lose everything because they couldn't survive the 30% drawdown that came before the 150% recovery. Position size is not a detail. It is the difference between participating in the window and being destroyed by it. Mistake 2, panic selling on the first dip. This one is predictable. Documented, universal. Every single recovery in every historical window. I've studied it includes at least one severe short-term drawdown that happens after the entry point and before the full re-rating. In the 2009 to 2013 recovery, investors who bought REITs in early 2009 experienced another 15 to 20% drop within the following 6 months before the sustained recovery began. The people who sold that dip, who said I was wrong, this isn't working, I'm cutting my loss, gave their position to the people who held and then watched from the outside as those same assets produced the returns they had originally come to capture. The first dip is not a signal that the thesis is wrong. It is the market testing whether you actually believe what you said you believed. Mistake 3, chasing the wrong version of the opportunity. The structural repricing I've described is happening in cash flow positive, conservatively financed income assets. It is not happening equally in speculative development companies, in highly leveraged office REITs, or in microcap property companies with low liquidity and questionable governance. The moment a structural thesis becomes publicly discussed, and this one is becoming more publicly discussed, the hype begins to bleed into adjacent, lower quality vehicles that carry the same category label, but none of the underlying structural support. Buying the category without examining the balance sheet is how people participate in a real opportunity and still lose money. Mistake 4, ignoring the tax consequences. I covered the Roth IRA advantage earlier, but here's the specific mistake that trips people up at the exit. Ordinary dividend income taxation. If you are holding income-producing REITs in a taxable account and receiving dividends classified as ordinary income, your effective return on that income is meaningfully lower than the headline number suggests. This is not a deal. It is a calculable cost that changes the math of your return expectations and should be built into your position sizing and vehicle selection from the start, not discovered at tax time. Mistake 5, telling too many people and getting talked out of it. This one is behavioral, and it is devastating. The moment you share an unconventional investment thesis with people who have not done the research you have done, with people who operate on the same mainstream financial assumptions that keep most people financially average, you are inviting their fear into your conviction. And their fear is not based on data. It is based on the same surface-level narrative that you have already looked through. The most dangerous opinion on your investment is the one that sounds sophisticated, comes from someone you trust, and is based on less information than you have. Trust your research. Share it with people who will engage with it seriously. Protect your conviction from casual dismissal. Now, the worst advice circulating about this opportunity, and I want to name specific categories of bad takes, because they are everywhere right now, and they are going to cost people money. Bad take 1. REITs have already recovered. The opportunity is gone. This claim is based on price action alone on the fact that REIT index prices have recovered from their 2022 to 2024 lows. What it ignores entirely is the valuation picture. Price recovery and valuation recovery are not the same thing. A stock can rise 30% from its low and still be trading at a significant discount to intrinsic value. The price to FFO data, the discount to NAV data, and the dividend yield spreads currently tell a story that is fundamentally different from the opportunity has passed. If someone tells you the ship has sailed, run. Here is why that thinking has destroyed portfolios before. It confuses price with value. Always bad take two. Wait for the Fed to cut rates before positioning. This is the most expensive form of caution I can describe, because by the time the Federal Reserve officially cuts rates, the market has already priced in the cut. The institutional repositioning has already occurred. You're not entering at the structural opportunity. You're entering at the retail consensus. The data from every comparable rate cycle shows that the best returns in rate-sensitive assets are captured by investors who position before the official policy shift, not after. Waiting for confirmation is the strategy of the person who got in at the worst time in 2009. The street doesn't wait for Wall Street to announce the coast is clear. Bad take 3. Real estate is dead. Demographic shifts have broken the model. This argument, popular in financial media since 2020, conflates the residential purchase market, which is genuinely complicated by demographic and affordability factors, with the income-producing investment market, which is driven by entirely different dynamics: rent growth, occupancy rates, replacement cost of construction, and supply constraint. These are different animals wearing the same category label. Conflating them costs people the ability to see the actual opportunity clearly. Now, exactly what you do this week. Day 1 is assessment. Before anything else, you sit down, not with a spreadsheet, just with honesty, and you answer 3 questions. What is my actual investable capital right now? Not including emergency reserves and not including money I will need in the next 3 years. What is the maximum position size I could hold through a 30% drawdown without panic? And what account structure am I working with? Taxable, Roth IRA, traditional IRA, or no account yet? Day 2 and 3 are education and account setup. If you do not have an account that is appropriate for this strategy, specifically a Roth IRA if you are or a standard brokerage account if you're not open one. Fidelity, Schwab, and Vanguard are all appropriate platforms for this strategy. The process takes 15 minutes online. Fund the account with whatever starting capital your day 1 assessment identified. No minimum required on most platforms. The account structure itself is the day 2 to 3 task. You are not buying anything yet. Day 4 and 5 are your first position entry. Based on your path selection, aggressive, balanced, or conservative, you are identifying your specific vehicle for the balanced path. Start with the Vanguard Real Estate ETF, ticker V, which gives you broad, diversified exposure to publicly traded REITs in a single, low-cost vehicle. For the conservative path, consider the Schwab US REIT ETF, ticker SCHH, which has a marginally lower expense ratio and nearly identical composition. For the aggressive path, you are selecting individual names, and for that specific process, I would need a dedicated video, which is coming. For now, your first buy can be in one of these broad vehicles. One purchase, one clean decision. Execute it before the week ends. Day 6 is risk management setup. This is not a stop-loss order. Those are not appropriate for a long-term structural position. This is the establishment of your personal rules, written down. What percentage decline triggers a review of the thesis rather than an exit? At what point would you add to the position rather than reduce it? At what portfolio weight does the position become too large relative to your overall financial picture? These rules do not need to be sophisticated. They need to exist in writing before the market tests them. Day 7 is automation and monitoring setup. Enable automatic dividend reinvestment through your brokerage. This typically requires clicking one checkbox in your account settings. Set a calendar reminder to review the 4 closing window signals I described every 90 days. Set a monthly automatic contribution, whatever amount you identified on day 1 as sustainable and painless. And then let it run. You don't need to have it all figured out. You just need to take the first step this week. Now, the last thing I want to say, because this is the part that actually matters most, and it is the part that no amount of strategy or timing or tax optimization can replace. The difference between the people who build wealth in windows like this one and the people who don't is not intelligence. I want to be absolutely clear about this because the financial world loves to imply that wealthy people are smarter. They are not. The research on this is definitive. Cognitive ability, as measured by standardized instruments, does not reliably predict investment outcomes. What does predict investment outcomes? And this is documented in academic literature going back to Daniel Kahneman and Amos. Tversky's foundational work in behavioral economics is the capacity to act on incomplete information without waiting for certainty, not recklessness, not gambling, but the specific psychological ability to recognize a structurally sound thesis, to size your position appropriately given your honest assessment of risk, and to execute, despite the discomfort, despite the doubt, despite the voice in your head that says, wait a little longer before the window closes. Every person who missed the 2009 window felt the same thing you might be feeling right now. They saw it. They understood it. They talked about it. They meant to do something, and then life intervened. The car needed repairs. The timing felt uncertain. Someone told them to wait, and they watched from the outside as the window closed and the people who moved got wealthy. This window is real. The data supports it. The historical pattern is clear, and the timeline, if the signals I've described are accurate, gives you a meaningful but not infinite runway. A year from now, you'll either be glad you watched this video or you'll wish you had. Drop a like if this helped. Share it with one person in your life who needs to hear this. And drop your situation in the comments, your starting capital, your timeline, your biggest obstacle, because I've read them. And the next video will be built around what you're actually facing, not what I think you're facing. The window's open. It doesn't care if you're ready.